Hello there. This is Mitch Goldberg. You're watching Be the Boss of Your Money. We've got a lot to talk about. We sure do. And today, the big news today is the stock market, is the rising COVID cases, its lack of a stimulus plan from Congress. A couple of things to talk about. We don't have big down days like this every day, although we've been having a lot more of them the last few years. So my name is Mitch Goldberg. You're watching Be the Boss of Your Money. We're going to talk about what the heck is going on with the market, the economy. It brings us to the election, and then we're going to do a quick update and all those good things. So stick around. We've got a lot to talk about. I'm going to roll the intro, and then I'll be right back. Okay, thank you so much for joining me. My name is Mitch Goldberg. You are watching Be the Boss of Your Money. I want you to be the boss of your money, not your money to be the boss of you. It's very easy for your money to become the boss of you. And on this show, we talk about personal finance, investing, business talk, and lots of topics that go with those other topics. Today, we're talking about the big down day in the market, worst day in maybe a month and a half. We've got an election coming up. Everybody is hypersensitive to every piece of news that comes out. It's not going to be changing anytime for the next, at least I have a feeling, week and a day, maybe a week and a few days. We'll see about the election, and we'll see if we know who's going to be president, next Wednesday. Okay, yes, I know the election is Tuesday, but hopefully we won't have to wait too long, maybe till Wednesday, to see who really is going to be the winner of the election and all that. So we've got a lot to talk about today. The market was down. It got absolutely pounded today. It was pretty much spread across the board. I can't say that too many sectors were immune to it. There are still a few things to hang your hat on here. I've been saying for a while that if we don't get a stimulus by the end of, by the election, we could see a 5 or 10% correction in the market. I don't think we get much more than that, because we'll probably get a stimulus next, February or March. Plus, we could get a very big stimulus in the form of an infrastructure plan as well. But we have to deal with the market in front of us, not the market that we want. For long-term investors, and hopefully you are a long-term investor, you're really not going to be overly worried about what's going on, because if you practice good personal finance hygiene, you've already moved some of your money out of stocks. The money that you have, money you need for financial obligations, obviously should not be in the stock market. So we're going to do a quick review today. We're going to talk about what's driving the market down. Is this here to stay? Everything kind of changed today. We knew about the rising COVID cases. It's not a secret. We've known for the last few weeks that COVID cases are rising. Now they're hitting new records in the United States, new records in France, new records in Italy. They're popping in Spain, right? They're just popping in England, and probably popping in other places around the world as well. So what changed? What changed? Like, why were we not worried about it last week when we had, high cases? Yes, they're higher now, but they were pretty high last week. So what's with the sudden changes? It's just that the number of 80,000 positive COVID cases is that enough to ignite some new form of worry? Because all of a sudden today, the worry is, are we going to have another economic shutdown and crush the economy again? Are we do we have to do it? I mean, we have more people with COVID positives today than last March. Or do we finally say, everybody wear your goddamn mask already? Cut it out. Just wear the mask. Everybody just buckle down for a few weeks. We could really reduce this thing and get back to at least something close to normal. People don't want to do it. And it's very sad. I look, in March, people weren't really fully, in April this year, people weren't fully aware of what the heck was going on, of the dangers. They became quickly aware in hot spots like New York, New Jersey, but other parts of the country, it wasn't that they're not aware. You just don't want to wear a mask. Like just wear the mask. Just try it. It's not going to hurt you. It's not going to hurt your oxygen levels. You're not going to stroke out because you're not getting enough oxygen because you're wearing a mask. You could stroke out if you don't get enough oxygen, which is one of the problems with COVID. This is serious stuff. I know I'm being a little glum here, a little gloomy, but everyone needs to wake up. I don't think viewers of this show are avoiding masks, but I would like everyone to wear a mask. Anyway, welcome to Be the Boss of Your Money. Welcome to a not such great news episode. We're live. I'm actually doing this live right now. If you're watching and you have any questions, please ask away in the comments. That's my favorite part of this, when people ask me questions in the comments. If you've got if you have some words of wisdom you'd like to share, words of encouragement, those are always appreciated. And you know what? Let me know where you're watching from. What city are you watching this from? That would be really cool to know. So I want to ask people that. I'm getting things like England, Australia, and it's pretty cool that people from around the world occasionally actually stop and watch me do my thing here. All right, let's do a quick review of the day, and I'll work in the everything you need to know while we do this. Okay. So here, what you're about to see, how the major averages did. I don't know if you could see this on your little smartphone there, but Dow down 650, down a little over 2.25%. Not a disaster. Look, we've had plenty of down days like this, and the fact is, we're still, way off our March lows. We're not too far from where we were pre-pandemic levels. S&P off about 2%, almost 2%. NASDAQ off about 1.6%. Russell 2000, that really took it on the chin as well. That's small cap stocks, and small cap stocks happen to be more sensitive to the domestic economy. So when you see people without stimulus, people without money to spend, that's what happens. Listen, by the way, a lot of people, I just want to say with the stimulus, I wish we didn't need the stimulus. And I am all for paying back the debt that our government owes. But when you need it now, you need it. And if we could sell bonds and the market will accept it, you might as well raise the money now while you still can. While you still can. There may come a day when you can't. The VIX skyrocketed up almost 5 points, up almost 18% to 32. The line in the sand has consistently been, for me, below 30 and then below 25. We were below 25 for a little while. The VIX is an indicator that says professional money managers, traders are stressed. When it goes up, it means that they're paying up for downside protection. So that's a level of fear and of stress, and it's really starting to build up. We've got election uncertainty. It's basically, I think we've passed the point of no return for a stimulus package before the election. I mean, it's a week away. A lot of politicians, most politicians in the Senate are running for re-election, and they want to campaign. They want to get back and campaign already. So I think a lot of politicians, both sides of the aisle, are just saying, whatever happens to the presidential politics, I have to do what I have to do to survive and save my political hide. Okay. Got a few people out there. Let's just take a look. Hey there, Filippo. What's the positives here, though? We did bend the curve. Deaths are down. We are closer to treatment and cure. We know a little more about the virus. Actually, we know a lot more about the virus. But yes, you, Filippo, you are bringing up a very good point. I think the fear is warranted, but eventually, at what point do we just say we must move forward? Buddy, that is like the $64 trillion question. At what point do you say, I could risk it? Some people are not going to worry about it. Look, one thing, like I have kids in public schools, right? High schoolers. And, one of the worries is that they'll be okay. They should be okay if they catch COVID. Don't get me wrong. There are youngsters who have a lot of problems from COVID, and there have been deaths. But by and large, younger people are less subject to the worst parts of COVID, but they come home, they can infect their parents like me who are over 50. They can infect, grandparents, and it just goes on. And then, it spreads out throughout the community. If wherever you wind up living, your school district, if your kids are in public schools, like literally becomes like the center of your life for a long time. Okay, so yeah, we are closer to treatments, to a vaccine. Look, but it takes a while to get the vaccine. We've already had a number of delays in the vaccine development, but we could know a lot more in November or December. So we do have things to get through this. We've got more ventilators. We know a lot more about the disease, and I think that's one of the reasons why stocks could hold up. Yeah, we could see, like I said, a 5 or 10% correction, but I don't think we do much worse than that. The real problem with COVID is this. I'm like talking about like I'm a scientist now, but I'm going to get into it. The real problem with COVID is not so much the the effects of it. Well, that is obviously a major part of it. But what we want to do is we want to avoid the surge, where if we could slow down the curve or bend the curve and slow it down so fewer people are going to the hospitals at the same time and stressing the healthcare system at the same time. That's like the real deal. Masks don't guarantee you against catching COVID. Social distancing is not a guarantee either. It's just to slow it down, bend the curve, so you don't have this giant rush all at once into the hospitals and stress the healthcare system, kind of like what we saw happen in New York last spring, and it was a disaster. I mean, when you turn on the news and you see refrigerated trucks parked in front of hospitals, I mean, nothing, no picture can tell you more about how bad it was than that, right? So that's that. But Filippo, let's just continue this. Mitch, do you think it would be wise to hedge puts, possibly gold, silver, cash? Just thinking here. Look, I think it's a personal decision. If you're a long-term investor and you like what you have, and your dollar cost averaging, investing in a 401k plan, I don't think it pays to hedge. I think you just let this go and just keep doing what you do, and then we'll be past this. Now, if you're an aggressive trader / investor and you've got a lot in the market and you don't want to necessarily get out of things, you like to be fully invested, then I think there are a lot of strategies that you could use to hedge. If you're someone who is, let's say, closer to retirement or closer to needing your money, and you're really worried about the stock market, to me, the best hedge is to just scale back on your stocks and either raise cash or put more money into bonds, that sort of thing, but reduce your risk assets. And then there are other things we could do. I don't think there's anything wrong with the hedging. It depends on what your goals are. You're not a professional investor. Nobody's forcing you to be invested. Nobody's going to say, hey, look at your Morningstar rating at the end of the year and say, you stink, we're taking all your money away. No one's doing that to you. So you could really get out if you want, get back in if you want. It's all part of the process. And you and I talk about this all the time. So we could definitely talk more about it. And I know this isn't all of your, we're talking about your trading money. Jay is out there. Jay, I think the European curfews were new and spooked people in addition to the more obvious fears. Yeah, look, curfews, they're not as bad as lockdown, so we could go to work. But yeah, curfews, it is a step toward a lockdown. Okay, so that's what's going on with the COVID. It's scaring the heck out of people, and people are starting to think that we're going through another lockdown. Take a look at interest rates. I always look at the 10-year Treasury. It's still above 0.8%, barely. The yield went down because bonds actually went up a little bit. So there's a little tiny bit of flight to safety, but not much. VIX, we already went over. TIPS, this is Treasury Inflation Protected Securities ETF. But you could see that bonds are up a little bit. Short-term muni bonds are off a touch. Okay, these are interest rate products. Gold off 170. Yeah, I know gold is not an interest rate product. It's not like a man-made bond or something, but I view it as an interest rate product because gold is just part of the interest rate complex now. That's how it's traded. Okay. The FANG stocks, Facebook was down, Apple barely up, Amazon barely up, Netflix down a touch. They had their down day last week, though. Big down day. Google down almost 3%, Microsoft down. So more or less a negative day for the FANG stocks. It's hard for the market to go up when the FANG stocks are so big that if they're not moving. I just want to say to everyone, I'm going to stop sharing the screen for a second, that I just took a couple of notes down before I got on here. Okay. The difference between now and last spring is that stocks today are a lot more expensive. So if you have a stock at $100 a share and it makes $10 a share in earnings, it's got a PE ratio of 10. If the earnings go down to $1, it's got a PE ratio of 100. So typically speaking, a PE ratio of 100 means a stock's a lot more expensive than a PE ratio of 10. That's an extreme example, but when we started our surge in March, everything had tanked. The Dow had gone down, and all the major averages had gone down massively. So things have recovered, and I just stocks aren't really as clearly they're not as cheap as they were last spring. But how do they compare now to the few weeks? Let's say the first month and a half or the first month of this year, of January 2020, they're still a lot more expensive than they were in the first month of this year. All right. So we don't really know if we have as much of a floor underneath stocks. It's just another thing to scare people out of the stocks. Mark, I see your comment. I'm going to get right to you momentarily. Reopening stocks just hit the skids. American Airlines crushed, UAL, Delta. You're not even seeing my screen right there, so I'm just going to show you. I'm going to show you my reopening list here. So American Airlines, UAL, Carnival, Norwegian Cruises, Planet Fitness. These are reopening stocks. Marriott down 5%. So those took in the chin. And by the way, if you're new to the show, I look at this here, the sector ETFs every day. The most important data set that I look at are the 11 exchange traded funds that represent the 11 sectors of the S&P 500. But utilities were the standout winner of the day. Yes, they were down a little bit, but that just goes to show you people are holding on to what they consider a safer dividend paying sector. At the bottom were energy, industrials, materials, and financials, which, by the way, those four sectors have been leading for the last couple of weeks. So they finally had a pullback, but this is a hell of a pullback for them. And when these stocks lag the most, when they're at the bottom, that goes to show you that there is a lot of worry in the market amongst investors. All right. So enough of the share screen. So Mark is out there. Do you think at some point the market will mirror the economy and jobs, therefore test lows we saw in March? Okay, Mike, you know what, Mike? I've called you Mark like 5 times. I do know a Mark Resnick, so sorry about that, Mike. Sorry about that. The print on my computer, it's like that big. So, yeah. A big question is, does the economy catch up to the stock market, or does the stock market catch up to the economy? We want the former, not the latter, because if the stock market truly reflected the economy, it would probably be a heck of a lot lower. We have to separate the stock market and the economy. The stock market, as it stands now, is not the economy. And what do I mean by that? It means that your super mega cap large stocks, all good. Thank you, my brother. Large stocks, which have led the market up the last few months. Your Facebooks, Amazon, Apple, Netflix, Google, Microsoft, a few others, but those are the the tops, the big heavyweights. They are not so much impacted by the economy. Their time to shine has been this environment where it's work from home, stay at home, and because they happen to be the largest market cap stocks in the S&P 500, which is an index. You can't invest directly into the S&P 500. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Just have to throw that in there. They have such a big representation in the average that they pull the average up. I mean, you could get rid of so many stocks in the S&P 500, you wouldn't even notice it. Especially probably the bottom 100. I don't think really even add anything at this point to the S&P, but your top 6 stocks represent close to 28% of the index. So we've never had a higher concentration than this before in the largest stocks representing the S&P 500. But those are more important. The economy could plunge and those stocks could keep going up. In fact, just the environment that we've been in has favored stocks like Amazon. So if those stocks do well and money managers fund managers want to keep buying those same stocks, that then I don't see the stock market buckling to the pressure of the economy. What we have been seeing is a little bit of tops, a little bit of upside coming out of the stocks. A little bit of recent performance has been coming out of those, and money has been going into some of the, industrial, economically sensitive companies like an airlines, and industrial machinery, things like that. Okay, Filippo, man, you are my man. Are there any sectors you feel confident in? Energy, I like XLE, and not sure what long-term energy industry looks like, but Chevron. Okay, well, look, the answer is if you believe that the economy is rounded the corner, and as of last week, I was saying the answer is yes, and I don't. This hasn't really changed anything. I mean, we could go into lockdowns, but right now we haven't, and I do see economic activity accelerating in a lot of areas. Even auto production, okay, is ramping up. We start using more oil. So if you believe in a cyclical recovery and we get stimulus, that would favor industrials, financials, materials, energy, consumer discretion. So that's what I would say. I don't know if I could really give my opinion on which ones to buy on this particular live stream, but yeah, I'm a believer still that the economy starts to pick up and we start to get a little bit stronger, even with the rise in COVID cases. Yeah, it could be a tough winter. The economy could take a hit, but I'm thinking 6 months, 12 months, a year out. I believe the economy will be on much more solid footing. If I'm wrong, I'm wrong. But this is why I own reopening. This is why I own reopening stocks and the economically sensitive stocks. And I'm diversified. I'm prepared for both. Better economy, worse economy. Diversification is a strategy that we use to mitigate downside losses, right? But it's doesn't necessarily protect your portfolio from going down in a generally down market. It's my little disclaimer on diversification. But that's why you have to have both. You need, you need to play for a retreat. You need to play for upside. Ultimately, stocks have moved higher over the long term. You have corporate managements that are doing everything they can to create more value for themselves and for their fellow shareholders. This is why you want to be aligned with management. And that's about it, folks. So that's my story for today. I'm sticking with it. Tomorrow, I'm going to have a really good guest. We're going to talk about Trump tax policy versus the Biden policy. And it should be a tax policy. It should be a really interesting show. So I'm looking forward to that. And Wednesday, I have Leslie Tain from the Tain Law Group, who is an expert. She's an attorney, and she's an expert in like credit, bankruptcy law, credit repair, and negotiating with your creditors, things like that. She's going to be terrific. And that's about it. So stick around this week. We've got some good shows coming up. All right. Take care, guys. Thank you so much.